Today, the crucial PCE price index has been published in the United States. This inflation indicator is one of the key guidelines for the U.S. Central Bank in making decisions on its monetary policy. Just a few markets will be able to assess the react to the red-hot statistics. The long Easter weekend is already underway in many countries, while financial markets of the United States, Europe, Hong Kong, and Australia are closed on an occasion of the Easter holiday. The Japanese authorities have to monitor the yen's dynamic. This week, they even come up with verbal interventions. A meeting of the leaders of the three main monetary authorities, originally scheduled for Thursday, was postponed to Wednesday to maximize the psychological impact on the markets. An emergency meeting of the Bank of Japan, the Ministry of Finance, and the Financial Services Agency was convened to discuss the catastrophically weak yen. After a similar meeting in September 2022, the country intervened in the foreign exchange market for the first time in 24 years. However, the yen's bearish trend continues to be head-edge for Japan's monetary authorities. Indeed, it drives up the cost of imports and reduces living standards at home. Meanwhile, the yen has settled at about the dangerous zone of 151.4 against the US dollar, and the Central Bank of China is also steering the yuan's movements on forex, and this week, for example, it also sought to stem the pace of the yuan's decline against the beyond US dollar. The main drivers of the US currency are still domestic economic data, the expected impact on the Federal Reserve, and also comments by the Fed's policymakers about possible auctions on the official funds rate. For example, Christopher Waller of the Board of Governors said on Wednesday that there is no rush to cut interest rates. Some of the recent economic reports have been disappointing. Thus, the regulator needs data for at least a couple of months to be confident that inflation is moving toward the 2% target. At the same time, the policymaker did not rule out the possibility of a cut in interest rates later this year. And yesterday, the U.S. Commerce Department reported the economy expanded by 3.4% in the fourth quarter of 2023 from a year ago. Moreover, GDP was unexpectedly upgraded from a 3.2% in the second estimate. In a separate report defining expectations, the number of initial unemployment claims decreased last week, thereby indicating the stability of the U.S. labor market. Wall Street's major stock indexes ended the session with minor changes, and the S&P 500 index closed the month and quarter in the overbought zone of 5,245 and 5,265 points. However, U.S. stock markets will only be able to respond to the latest data on Monday. European stock markets will do so even later, as they will open for trading only on Tuesday after the long Easter weekend. The single European currency was initially a double loser today. Inflation in France has been losing its grip, and the annual CPI slowed to 2.3% in March, the lowest level since September 2021. At the same time, there is a growing consensus within the ECB policymakers regarding a rate cut in June. Yanis Stoumaris, the Bank of Greece governor, announced this on a Tuesday. Francois Villeroy, who is on the Board of Governors, noted the rapid decline in core inflation, and his colleague Fabio Panetta believes that the fall in consumer prices is driven exactly by the ECB hawkish policy. As we see, economic and monetary aspects seemed to line up in favor of the US dollar and against the euro. The Federal Reserve's hawkish rhetoric and the healthy domestic economy support the US dollar. Its index opened trading on a Friday vigorously in the green corridor of 104.54 to 104.68. But then dollar bears took control. During a sell-off, support for the dollar index relative to its six peers fell to 104.42 points. The fact is that the index of personal consumption expenditures published today in the United States showed an increase in consumer prices by 2.5% in annual terms. Thus, its February figure exceeded the forecast as well as the level of 2.4% in January. The core PCE, which excludes volatile food and energy prices, rose by 0.3% on year, and this brought core prices to 2.8% in February, down slightly from the upwardly revised 2.9% increase in January. Another reading below 3% indicates a sustained decline in US prices. Accordingly, market sentiment on the euro-dollar pair has been revised. On the one hand, the confidence that the ECB will begin to cut its interest rates earlier than the US Fed works in favor of the dollar. Amid the firm greenback, the euro was weakening for 3 days in a row. The single European currency managed to test the area below the psychological level of 1.08 and slipped to 1.0770. On the other hand, the currency market is thin today because most market participants have already left for the long weekend. In addition, the dollar unexpectedly received a blow from a falling inflation in the United States and began to weaken itself. As a result, euro sellers challenged the greenback strength, and this time the euro made an attempt to regain the lost high of 1.08. If the instrument settles above this level at the end of the week, the bulls will get their second chance. However, the sustainability of the uptrend looks doubtful, so the bearish trend is likely to resume and the euro-dollar pair will move towards 1.07 and the local low of February. Oil prices ended March and the first quarter of 2024 with strong gains. Brent crude rallied by 4.6% this year, and its price soared by 13.6% in the first quarter. The oil market is not available for trading today, so Brent crudes have returned to $87 per barrel. That's they are staying at the upper border of the range of 85 to 87, in which they have been stuck since mid-March. If the new background remains calm, then oil prices will begin to shift towards $85 per barrel. In the near future, however, buyers are still holding the upper hand in the market. The main catalyst for the growth of oil prices are the plans of the OPEC and its allies to reduce oil output rates. Besides, a decrease in the number of drilling rigs in the United States is also bullish for oil prices. Although radical shifts have not yet been observed, things can still change. Hence, if the Brent price settles above $87.50, it's highly likely that the bullish momentum will continue. As for the alternative scenario, it suggests that the price might get trapped in the range of $85 to $87.5 per barrel. You have watched the market review by InstaForex analyst for Friday, March 29, where we discussed sentiment in financial markets on the final trading week of the first quarter. Enjoy your weekend. Subscribe to InstaForex TV channel and see you online next week.